It is happening again. The same frantic energy, the same breathless promises of a new utopia, the same charts that defy gravity. Today, we call it artificial intelligence, a force poised to remake our world, solve scarcity and disease, and unlock permanent prosperity. A fundamental paradigm shift. But in 1999, we called it the Internet. This is not a video about technology. This is not a video debating the potential of AI. That potential is undeniable. This is a video about the blueprint of a financial collapse. It is a warning that the AI revolution is not a new event. It is a carbon copy, a precise historical echo of the dot-com catastrophe, a catastrophe that, when it burst, wiped out over $5 trillion in market value, vaporized the life savings of millions, and exposed the hollow, rotten core of manufactured hype. The problem is never the technology to pasam. The problem is human nature. The problem is the system, which is programmed to seek out, inflate, and destroy. And that system is now flashing bright red. We are being told in the exact same words that this time is different, that the valuations are justified by the scale of the revolution, that the profits, real, tangible profits, are just around the corner. This is the core investigative question. If the AI boom is a genuine revolution, why does it look, sound, and smell exactly like the most infamous financial bubble in modern history? History does not repeat them, but it rhymes. And the rhyme of 1999 is not a whisper. It is a deafening siren that we are, once again, being paid to ignore. To understand the present, we must dissect the past of some, not as history, but as a diagnostic tool, a forensic blueprint. Let us compare the symptoms. Symptom number 1, the metrics of insanity. In 1999, the old rules of finance were declared obsolete. Profits did not matter, revenue was secondary, cash flow was a relic of a bygone industrial era. A new, magical metric was invented: eyeballs. How many people were looking at the website? That was all that mattered. A company like Pets, a company that famously sold dog food online at a loss with every single bag, was valued at over $300 million at its IPO. Why? It had eyeballs. It had mind share. It had a sock puppet in a Super Bowl commercial. A company like Webvan, which promised to deliver groceries to your door, raised $375 million, vowing to build a $1 billion infrastructure. It was valued at $7.9 billion. It went bankrupt in 2001. Investors scrambled. A man in a cheap suit stands in a crowded, chaotic trading pit. He is screaming, waving a piece of paper, desperate to buy shares in a company he cannot explain. He only knows it is .com. The ticker machine accelerates into a frantic, deafening cacophony. He does not care about the fundamentals. He only cares about the momentum. He was told the new economy had suspended the laws of gravity. Pets, com, Webvan, GeoCities, https www.google.com/search, QBoo.com. Hundreds of them, all promising a revolution, all went bankrupt. The eyeballs never, ever translated to profit. Does that sound familiar? It should. Fast forward to today. The word eyeballs is gone. It has been replaced by a new, more sophisticated and equally meaningless mantra, AGI, Artificial General Intelligence. We are no longer buying clicks. We are buying the promise of a future superintelligence. Look at the landscape. Startups with no product, no revenue. And sometimes only a handful of employees are raising hundreds of millions of dollars at multi-billion-dollar valuations. Their value is not based on what they sell. It is based on the theoretical size of the total addressable market for a technology that does not yet exist. We see hundreds of AI wrapper applications, thin layers of code on top of an OpenAI API essentially, renting. OpenAI's technology all claiming to be revolutionary. This is the 2025 equivalent of the 1999 GeoCities page, a basic HTML template claiming to be a media empire. It is pets, repackaged for the 21st century. To be clear, the parallel is not that the technology is worthless. The parallel is the infinite valuation assigned to a finite and unproven business model. Pets, was a real company, but it was not worth $300 million. The AI models are real and powerful. But are they worth trillions of dollars in consolidated market cap? Symptom number 2, the media amplification. The narrative machine. In 1999, financial news channels became 24/7 hype machines. Analysts, whose investment banking divisions were underwriting the very stocks they promoted, appeared on television night after night. They were not analysts. They were salesmen. They spoke of paradigm shifts, first mover advantages, and get in or get left behind. They created a feedback loop of pure euphoria. The media reported on rising stocks. The rising stocks validated the media's narrative, and the public, the retail investor, watching at home, felt the agonizing grip of FOMO. Fear of missing out. They poured their retirement savings, their children's college funds, into companies they read about in a magazine. Now, look at our screens. The medium has changed. It is no longer just the cable news anchor in a stiff suit. It is the slick tech influencer on social media, filming in a pristine studio. It is the venture capitalist on a podcast, painting a messianic picture of inevitable technological singularity. It is the billionaire CEO tweeting cryptic promises of AGI. The message is identical. You are missing out. This is the next trillion-dollar opportunity. This is the greatest wealth creation event in human history. Get in now or be left behind. The euphoria is manufactured, amplified, and algorithmically targeted directly to your psyche. The goal is the same: to pull in the retail investor, the dumb money, right at the peak of the mania, to provide the exit liquidity for the insiders. In other words, a flood of new, eager buyers, allowing the early investors to sell their shares at the absolute peak. Symptom number 3, the picks and shovels delusion. The argument, both then and now, is that even if the individual companies, the gold miners, fail, the companies selling the infrastructure, the picks and shovels, are a guaranteed, ironclad win. In 1999, this meant the plumbing of the internet. Companies like Cisco Systems, which made the routers, companies like Sun Microsystems, Nortel, JDS Uniphase. Their valuations soared to astronomical, incomprehensible levels, far beyond any rational projection of future growth. Because the logic went, everyone will need routers. At its peak in March 2000, Cisco was the most valuable company in the world, worth over $500 billion. When the bubble burst and the thousands of dot-com companies went bankrupt, they stopped buying routers. Cisco's stock collapsed. It fell by nearly 90%. The argument is not that the technology is flawed. The argument is that the valuation has priced in decades of perfect, uninterrupted growth. Cisco was a real, profitable company, but its stock price was a fantasy. When the dot-coms stopped buying, that fantasy evaporated. The risk for today's picks and shovels is the same what happens if the AI spending, driven by hype, slows down even 10%. It took 15 years for the stock price to recover. Today, the picks and shovels are the GPU manufacturers, the chip designers, the cloud providers, and one company, Nvidia, has become the Cisco of our time, but on an even more massive scale. We are told that even if the AI models fail, these companies must win because everyone will need chips. We see the same vertical stock charts, the same dismissal of valuation as a quaint, outdated concept, the same frantic, desperate belief that there is no price too high to pay for the infrastructure of the future. The system is not just rhyming, it is executing the exact same code, line for line. This frantic demand, this belief in infinite growth, it creates the perfect conditions for the next phase of the collapse. The real catastrophe was not just the money lost on vaporware, it was the blueprint it created. A blueprint that would be perfected 2 decades later. This is not an accident. A bubble of this magnitude is not created by public enthusiasm alone. It is engineered. It is an architecture of hype, designed by the very institutions that claim to protect us. We must ask cui bono, who benefits? Look at the timeline. The world just exited the ZIRP era, the zero interest rate policy, a long period where central banks made borrowing money virtually free, flooding the system with cheap cash for over a decade. From 2008 to 2021, that money had to go somewhere. It was a fire hose of capital looking for a home. It created the everything bubble stocks, real estate, cryptocurrency, risky corporate debt, when the inflation, which they promised was transitory, arrived like a freight train. The central banks had to slam on the brakes. They had to raise interest rates at the fastest pace in history. The party stopped. The music died. The easy money vanished. Wall Street and Silicon Valley were left with a massive, existential problem. The growth story was over. The venture capitalists were sitting on portfolios full of cash-burning unicorn startups that were suddenly worthless in a high-interest rate world. Their entire business model, which relied on flipping these companies to the public market, was broken. The investment banks, which facilitate initial public offerings, IPOs. The process of taking a private company public to sell stock needed a hot, new sector to sell to their clients, allowing them to collect massive fees and restart the money machine, the trillion-dollar tech companies. Seeing their core businesses like digital advertising mature and slow down, needed to convince investors they were not being left behind. So they began a spending war, pouring billions and billions of dollars into AI initiatives, whether they needed them or not, just to signal to the market that they were still growth companies. The AI boom became the ultimate bailout, a financial bridge built entirely on narrative to carry the system over the valley of a recession. But the bridge is made of paper. This alignment creates a dangerous, deafening illusion of consensus. When every major bank, every major tech company, and every major media outlet is repeating the exact same story, it is very difficult and very lonely to see the truth. The truth is that the system is addicted to bubbles. It needs them to function. It inflates them, profits from them. And when they inevitably burst, it is the average person, the retail investor, who is left to clean up the wreckage. The dot-com crash was not a lesson learned. It was a training manual. But this bubble, the AI bubble, has a unique flaw. A glitch in the code that the dot-com bubble did not have. The dot-com bubble was built on hollow promises. The AI bubble is built on hollow promises. That also cost billions of dollars just to operate. This is the key difference. This is the part they do not want you to analyze. This is the red pill. The dot-com era was cheap. A few coders, a rented server, and a good idea. You could create a website for almost nothing. The idea was the product. The cost of scaling was low. Artificial intelligence is the opposite. It is the most expensive, energy-intensive, and physically demanding technology in human history. Let us talk about the dirty secret of AI. The cost, the physical reality. First, the training cost. A single flagship AI model, like GPT-4, cost its creators over $100 million to train. The next generation, the models being built right now, cost in the billions. A single training run. This requires a supercomputer, a vast data center, and enough electricity to power a small city for a year. This is a game only a handful of trillion-dollar corporations can play. It is not democratized. It is a technological oligarchy. But the training cost is not the real problem. That is a one-time capital expenditure. The real glitch, the one that breaks the business model, is the inference cost. Inference is the cost of using the AI, the cost of asking it a question. Every time you use an AI chatbot, it costs the company running it thousands of times more than a simple Google search. A traditional search is cheap. It just finds existing, indexed data. An AI query creates new data, computes an answer, requiring massive computational power from a cluster of expensive GPUs, the same high-end chips used for video games. Every single time, this cost is astronomical, and it does not scale down. The more popular the AI becomes, the more money its creators lose on every free query. Think about that. The core business model for mass adoption is the more successful we are, the faster we go bankrupt. This is the glitch. We are seeing valuations based on mass adoption for a technology whose economics collapse with mass adoption. It is a fundamental structural paradox. The counter-argument, of course, is optimization, the hopeful cry that costs will fall, that new models, smaller and more efficient, will solve this problem. But this is not a fact, it is a hope. It is the 1999 belief that profitability is just around the corner, repackaged in technical jargon. These companies are burning billions of dollars in cash, not on profits, but on betting on a future, unproven technological miracle before the investor money runs out. And there is a second, even darker, physical cost: energy. The data centers required to run this AI revolution are projected to consume more electricity than entire continents. We are talking about a demand for power so large that it is sparking warnings of grid instability. The issue is not just the current consumption, it is the rate of growth. The hype promises a world where everyone uses AI for everything. But the physical grid cannot scale at the speed of the stock market's imagination. This is not a financial problem, it is a wall of physics. The bubble's narrative is writing checks that the laws of thermodynamics cannot cash. This is not a new economy that exists in the ether. This is a physical, industrial machine that consumes more resources than the old industrial economy it claims to replace. They are not just building websites, they are building the equivalent of a global fleet of nuclear reactors. On pure speculation, the dot-com bubble was a bubble of pure psychology. It was a software glitch. The AI bubble is a bubble of psychology, anchored to a reality of crushing, immense physical expense. When this one bursts, it will not just be stock charts collapsing, it will be data centers being liquidated. It will be a physical, tangible implosion. They are leveraging their assets 50 to 1, believing the risk is 0. Does that sound familiar? It should. This channel does not provide financial advice. Our mission is to provide historical context, to act as a warning system. So, what does the history of the 1999 collapse teach us about the strategy for survival? When the dot-com bubble imploded in March of 2000, it felt like the end of the world. The Nasdaq index fell nearly 80%. The new economy was a graveyard of broken companies and shattered dreams. But it was not the end. It was a filter. It was a violent, painful, but necessary process of separating the hype from the substance. Pets.com died. Its sock puppet mascot became a symbol of the era's absurdity. Webvan died. Its fleet of delivery trucks was auctioned off for pennies on the dollar. But Amazon.com survived. It also lost over 90% of its stock value. It was brutal. It was terrifying. But it survived. Why? Because underneath the .com hype, Amazon was building a real, tangible, boring business. It was building logistics, warehouses, shipping networks. It was generating real revenue from real customers buying real products. The lesson of the collapse is simple, and it is timeless. Hype cannot survive a recession. Eyeballs cannot survive a recession. The promise of a future technology cannot survive a recession. What survives as value? What survives is profit, cash flow, businesses that solve a real problem for a real price and make a real margin. The AI bubble will burst. That is not speculation. It is the inevitable conclusion of its flawed architecture. The only question is when. And when it does, the public will once again be left holding the bag. The survival strategy, then, is not to predict the timing. It is to apply the filter of 1999 to the world of today. To ask the hard questions. Is this company generating hype, or is it generating cash? Is this asset based on a story, or is it based on substance? Is this company using AI to improve a real, profitable business? Or is this company selling the AI dream itself? Am I investing in a revolution, or am I, once again, just the exit liquidity? History is a warning. The code is executing. The patterns are identical. The choice to see them is yours.